Great. I think let's get going. All right, brilliant. Everybody, thank you so much for joining us for this webinar today, titled Where to Invest in the Current Environment, 3 Different Approaches to Solving the Same Problem. My name is Martin Hard and I'm Head of Distribution at Sasfin Wealth. And I think as the title says, 3 different approaches to solving the same problem. We're very fortunate today to have 3 very experienced members of Sasfin Wealth. We've got Arno Lorenz, Errol, Shear, and Andrew Padoa. Each of them will speak between 15 to 20 minutes, giving you their unique approach in terms of, I suppose, how do we make money in this current environment. We know what's happening around the world geopolitically. We know what's happening locally. We've all heard of it, a number of times this year that it's quite a unique year. I think over 60% of the globe is having a poll of some sort. So there's going to be a lot of changes in governments, etc. So it certainly is a unique time. And hopefully the objective of this is really to give you as advisors the ability to make the right decisions for your clients, and certainly 3 different types of ways of getting to maybe the same goal that you're looking for. So there will be CPD points. So we have sent the applications, etc., all through to the FSCA. So as soon as we get that back, we will provide you with the relevant certificates, etc. As I mentioned, we have asked each presenter to keep it to 15 to 20 minutes, and then obviously to make allowance for questions at the end. I think the way we'd like to work it, if you could write your question in the Q&A box, and then we'll deal with all the questions at the end after the presenters have spoken. So first up, we have Arno Lorenz, then Errol Shear, and then Andrew Padoa. So just quick high level, Arno will be talking around income solutions and how income can help you really to assist your clients. We've then got Errol Shear. He'll be talking around multi-asset class and how through his solutions you can make money for your clients. And then at the end, we've got Andrew talking around equity solutions and how we can make your money for your clients through that solution. So without further ado, I'd like to welcome Arno Lorenz. A lot of you would know Arno. He's well known and certainly a doyen, I think, of the asset management industry. Arno is the CIO of our asset management business. He's got a wealth of experience. He spent a number of years at Coronation. He actually set up probably a fund that a lot of you would probably be well aware of. That's the Coronation Strategic Income Fund. He spent some time at Old Mutual. He set up his own asset management business, Atlantic, that got bought out by Ashburton. And then he's today is with us at Sasfin, and I think going on to 4 years at Sasfin now, Arno. So yeah, without further ado, I'd like to welcome Arno to give you his view in terms of how we can solve this problem of assisting your clients through income investing. Over to you, Arno.
Great, thanks, Mart. Just let me know when my screen is up, if you can see it.
Yes, we can see it.
Great. All right. Thanks, Mart, for the intro. It does sound like I've had quite a journey through both large and small asset managers. But again, we know that the world is never a linear thing. So you're always learning. It's never as if you've arrived. So I think it's important, and I'm sure Errol Shear, who's been in the markets for even longer than what I have, will attest to that as well. As you noticed, the order that we're going to be doing is fixed income, multi-asset, and then equity. So basically, it's from the low-risk guys to the high-risk guys. And I've got to basically argue my case, I suppose, in a sense, to position the fixed income space. But again, each has its place. And I think hopefully what you hear from our panel is got a place in each one of your clients' needs, basically. Okay, so fixed income. And I've titled it Using Fixed Income to Grow and Protect Wealth, which might sound a little bit strange because typically we tend to think of the growth asset side of the equation ultimately being essentially the equity space. So I suppose my job here is to paint the picture or the case for fixed income. So when you look at this chart, you can see I've used the S&P 500, the growth assets, right? So that's equities. So that's what you're trying to do. You invest into equities for growth. And obviously, as you have various cycles, you'll see that you have additional volatility. The alternative, of course, is to invest in the bond market, and that's the orange line. And you'll see that there are times when you have significant downturns in the equity market. I've highlighted the four big ones here, around about 2000, which was the tech bubble bursting, global financial crisis of 2008, 2009. COVID was very brief, we know, and then obviously the one right at the end, more recently in 2022. And when you look at this growth asset class and compare it then in terms of the bond market, you'll see I've highlighted with these orange arrows, is that in those times of downturn of the markets, the defensive assets being the bond market protects your wealth. And so the combination of that, which is ultimately what Errol's going to be speaking about, where you're combining asset classes, makes a lot of sense. But there's one point here, which is right at the end, where you can see that in 2022, your defensive assets didn't protect you. So there was a downturn in the bond market as well. So suppose the question would be, what happened in 2022 that it was not a defensive asset? So when you look at this table, and I've run through the big three periods, so that was around that tech bubble bursting, the global financial crisis, and then the more recent 2022 market shock, if you want to put it like that, the post-COVID market shock. So that's not the actual COVID one. You can see over that period, S&P 500, substantial numbers down in terms of returns, and then the corresponding return in the bond market. You can see the first two periods were positive. So yes, it did its job in terms of protecting wealth. And then, of course, the one where it didn't work, where it was down 16% in the bond market. And the question is why? And I think the last two columns help to explain this, which is that the starting yield at the start of these periods. So if you look at the top line, for example, the starting yield, the 10-year bond yield in August 2000 was 6%. By the end of this period, July 2002, the bond market yield was 3.75. And you know the story, when bond yields fall, you get capital gains, and hence the 18.6% return. But here's the point that I'm leaving you with here, is that the starting yield does matter. So when you look at this period of 2022, the bond yield was at 1.4%, 1.5%, and it ended at 3.95. So actually what happened was, because the shock was derived from a higher or substantially higher and stickier inflation than what was expected, bond yields actually went up. So that was what was driving it. So if you're starting at a low point, then you essentially have no room essentially for yields to fall much further. So then if you think about today's starting yield in the case of the US Treasury market is 4.6%. So there is scope then that if there were a downturn in the equity market, there's a good possibility then that a flight to safety would again deliver some positive benefit to that investment, and hence you would get some capital gains, and it would be then a true defensive asset again. But I think that the point here is the starting point does matter. Having said that, that doesn't just apply for the bond market, it also applies for the equity market. I won't go through there's a whole range of indicators you can use in terms of valuations, but this one's an interesting one because it's quite a popular sort of way of looking at it. It's called the Warren Buffett indicator, or the Buffett indicator. Ultimately, you can see on the right-hand side that this indicator is essentially takes basically the market cap of the whole of the US stock market and divides it by the size of the economy. So if markets are growing really, really strongly, the question would be why? Well, maybe it's because the economy is growing really, really strongly. But you're getting situations like we've seen over the most recent past, as well as clearly here around the tech bubble bursting, when the market runs ahead of the economy. And of course, that means your starting point for the equity space is also probably somewhat constrained and points to issues around the prospective earnings growth over the next couple of years. I'll leave that for the equity guys to deal with. So if you look at 2024 and the four key issues, I think Mark actually touched on them. Global interest rate at a peak. When does this descent begin? So again, from an income perspective, it's pretty crucial because you want to lock in those yields while they're still high, rather than waiting for it to start falling and then it's almost too late. Inflation pressures, as we know, have subsided, but there are new supply chain risks emerging. And potentially, again, you've seen what happened with this week with Biden's tariffs against China. So again, a new trade war. What does tariffs mean? Higher prices. So again, there are some pressures around that as well. And of course, Mark touched on the electoral change. What that means for markets is uncertainty around policy decisions. I mean, you can just think about the South African story, which is, the outcome is uncertain. Will we have coalitions? What sort of change will we see in policy? So those are issues that we're going to have to deal with. And then geopolitical flashpoints, as we've seen, they can lead to systemic shocks as well. And when you add that together, the high interest rates mean high cost of capital, the equity valuations, all of this uncertainty around monetary and fiscal policy, probable market stagnation within a fairly broad range is probably a sort of a base case that you'd probably want to argue. So in a South African context, when we speak about this wealth creation and wealth protection, using growth assets and defensive assets, that's actually quite a difficult one relative to the US. I mean, I touched on the US where you can clearly see it. You can clearly understand where the starting points are. So when you're looking at making an investment plan, you can look at those starting points and make a decision around it. In the case of South Africa, though, we have a problem. All right. The problem is this. If you then look over the last 10 years in particular, where you have your growth assets and your defensive assets being the bond market, is that the growth assets haven't been growth assets. So, I could argue the case that over the last 10 years is that the bond market in the orange is actually been both your defensive asset as well as your growth asset. So again, from that perspective, there's an issue here in the South African context, which is that for financial planners who are trying to sit down with clients and trying to formulate a strategy to get to some investment objective and have exposure to growth and so forth, is that you are going to be fairly constrained because of what's been happening in the South African equity market for various reasons. And ultimately, if one wants to understand why has this been the case, then you can look at the last 10 years of South Africa's GDP, and there's a very clear trend here, which is that ultimately South Africa over the last 10 years has been close to recession, if not in recession, for pretty much most of this time. And that's the environment in which we're in, that essentially we are almost in perpetual recession. So the question would be, is that does this election that we've got coming up change anything? We don't know yet. We don't know who is going to be in power. We have some sense. You can go to the polls and have a look and see, what they're saying. And I won't cover that in detail. But the point being here is that unless one sees structural shifts in policy in South Africa, then you're probably going to see more of the same. I think that's pretty much what one would do. Again, when one thinks about forecasts, in particular around the Rand, generally speaking, the best forecast for the Rand is whatever the value is today, because it can go up, it can go down. And we know over longer periods of time, there's that depreciation. If I touch on the election side of things, is that if I look at the election manifestos of two of the key parties, and in particular, if one thinks about in KwaZulu-Natal, which for most of you is home and my hometown, is that if I look at what the EFF is saying is been the problem in terms of that economic growth rate, then they're quite succinct, and they basically say it's due to an incompetent, directionless, and visionless government. That's their sort of diagnosis as to the ills. And then you've got the new party, which has emerged, Mkhonto weSizwe, and in their manifesto, they basically say that two key things that I've highlighted here. One, South African society is adrift from its core values and is struggling with moral decay. And secondly, essentially they're saying that the constitution is too liberal, and therefore it is constraining the ability of government to basically do what they need to do. So if I just use the example of the national health insurance that has just been signed into law yesterday, I don't see where the constitution has prevented them from doing that. So there are these issues. And then you say, the point I left you with, unless you see significant positive structural shifts, we probably are condemned to being a muddle through, as we've seen over the last 10 years. And so hence, I think there are still significant constraints to economic growth in this country. So I'm going to park it at that, but essentially remember that these two parties could well be the kingmaker, depending on what the result is for the ruling ANC. Okay, if you look at the US economy, again, just take a step back in a sense. And if one wants to understand what you're getting in the US, and I'm honing in on the US because essentially being still the largest economy in the world, and having that significant growth aspect as far as growth assets are concerned. So yes, you can scan this barcode if you want to, and you should see how much you're going to pay if you want to invest in the US. But actually, this is not quite the case. And in fact, what this chart does show, it's not a barcode. This is essentially demonstrating over time, US economy, when it has been in recession, going back to 1854. And the reason why I used this is because when I first saw this, I thought it looks like a barcode because there's a very distinct pattern here, which is that up until, let's call it the Second World War, there were a lot of recessions and they were very, very frequent. And what you've seen as subsequent to that is that, they've been starting to spread out. Now, you can argue probably two things around why that is the case. One would be perhaps more or a better understanding of how economies work. So if one thinks about, the famous economists, Keynesian economists and so forth, better understanding means better monetary policy and a better management of the business and economic cycle. That would be one argument you could make as to why they have become a lot less. And then perhaps the second argument you could make would be that in the case of the US, particularly after the Second World War, the transition from, let's call it a manufacturing economy to a service economy, where a service economy perhaps is more robust and less vulnerable to economic downturns. So that perhaps the combination of that is really sort of what you end up seeing. So I think when you go to the US and investing there as the proxy, if I use that for the growth asset, ultimately, because I'm saying that in a South African context, you've got significant headwinds. And in the case of the US, all economies have some headwinds. But ultimately here is that because recessions are so much fewer and far between, is that, growth has ended up being a lot or significantly higher from that perspective. And it has enabled ultimately what the stock market has performed. Okay, so let's go back to South Africa and let's call it the economic election, which is where foreign voters have a say. And what I've highlighted here is the last 10 years. This is cumulative foreign flows in the equity market, the bond market. So where I've highlighted 2014 up to that point, the starting point of the chart ultimately is a little bit earlier. But you had essentially a move from a cumulative in the case of equity about 300 down to a negative 600, that's about 900. And the same with the bond space at the point in 2014 of cumulative 200 down to about 700. So you're left with about 1.8, 1.9 trillion rand that has basically left our markets. The positive to this could be argued that if South Africa does start getting things right, the money could come back. Having said that, bear in mind again that we are a very small economy by global standards. But again, the benefit of that would be you only need a little bit of foreign flow in order to make a difference. So the key would be confidence in our direction. And I think that's ultimately where it all comes down to. In the fixed income space, if one looks at what do you get out of fixed income? You're getting an income return and you get a capital return, which ultimately the capital return is as a result of a move in bond yields. So if I look back over the last 15 odd years, and you look at some of the negative moves starting in 2009 with the global financial crisis and systemic risk, you had essentially a 10% fall in a rise in yields. And even though you were getting around about 8% income, which is the blue component, so right on the left, you'll see that the net return was slightly negative because all the income return was eaten up by the shift in bond yields. You had the EM taper tantrum 2013. You'll remember Nenegate in 2015. which ate up almost all of your, well, more than all of your income. And then through to the bond market sell-off of 2022 because of the inflation story locally and globally. But again, here's one little aspect to look at in the bond market, is that if you look at very much on the 2023 perspective, and you can actually see the income component has popped above 10%. So this is because bond yields in South Africa have been rising, as one well knows. And so as those bond yields rise, you know, the income component of your return is actually going up with that. So as you're investing into this, the income component keeps pushing up. And as we've seen in 2024, bond yields have risen further over the course of this last 3 months. And so your income return is now well above 10%. So you're looking at 10.5% odd. And so if one thinks about it from that perspective, that you're getting a 10.5% to 11% income, you need to have a very substantial sell-off. And let's call it, say, an 11% sell-off or even a 12% sell-off in capital would then eat up all of that income. So the question would be, what move in bond yields would take you down 12%? And if one looks at the all bond index duration of around about 5.5, that would mean a 2% rise in yields is what it would take for bond yields, essentially, for the bond market to deliver a zero return for the year. And so your starting point for the return is that income. And as long as we remain in a fairly broad range, your starting point is actually what's going to deliver for you the returns. Here's an interesting way of thinking about this as well. If you go back 10 years, and I've highlighted here the 16th of May, 2014, so it's precisely 10 years ago, the starting 10-year bond yield was 8.36%. The return on the on the ALLB, sorry, it's not it's the 10-year return on the ALLB, not the return on a 10-year asset. The all bond index return was around about 7.9%, right? And remember, the all bond index is made up of 10-year bonds, 20-year bonds, 30-year bonds, and a host of shorter dated ones as well. So it's essentially a basket of but your 10-year yield gives you a very good, almost sort of rule of thumb here as to what the subsequent 10-year return is going to be. And that's despite, as I showed you in this previous chart, despite bond yields rising over that 10-year period, because the income return is so powerful, it starts coming through in terms of the actual returns. So when you think about the current 10-year bond yield of actually over 12%, if that's your starting yield, then I can tell you now, when we have this forum again in 10 years' time, and we look back over the period from 2024 to 2034, I would vouch that your return in the bond market is going to be in the order of close to 12%. And so it's a very solid rule, and it comes out of the fact that the predominant component of return in the income space is from the income component. So you have the volatility, sometimes up, sometimes down, but overall, this speaks to what your return is going to be. Now, if you think about this return relative to, for example, inflation and relative to prospect of equity returns, is that you're starting to get equity-like returns out of the bond market. And so this is the challenge which an Errol and an Andrew are going to face in terms of their stock picking skills in finding those assets that can grow by this or more in order to keep pace with the bond market. So my question would be, do you need growth assets or defensive assets? And I'm arguing here that in a South African context, these sorts of hurdle rates in terms of returns are going higher and higher. And so it's starting to make Andrew quite nervous, I'm sure. But you can answer that one, Andrew. Right, so if I then turn to our solutions in the fixed income space, and I've highlighted our flexible income fund and our high yield fund being the recipients of a number of awards. And that really speaks to the fact that, throughout this period, in terms of the fund's history, we've had a really fantastic team at work. And in particular, I'll highlight Rafi Ruchin, who's been there from the beginning of these funds being launched all the way through till today. So the two solutions that we have that we're positioning in front of you today, the flexible income fund, ultimately it is one which tracks bond yields. So as bonds essentially rise, fall, it will essentially track that. We're trying to deliver a return that essentially is a bond building block. So if you look at the all bond index, then that's essentially the sort of return that you're going to get with a lower volatility, which is ultimately what we're trying to do. And in the case of the high yield fund, this fund is a low volatility fund, very little duration, and it tracks the interest rate cycle. In other words, then you look at what the SARB is doing. If the SARB's keeping rates constant, then the yield on the fund is going to be pretty much constant. If the SARB hikes rates, that's great for this fund. And that's one of the reasons why it ran the Raging Bull Award, because it's in the sweet spot. At the peak of the interest rate cycle, this fund is delivering exceptional returns, in particular with very, very low volatility. So flexible income fund compared to the all bond index, right? So again, bond-like return, you can see very clearly it's tracking the all bond index. So if I position this as a growth, as the defensive asset being the bond space, as we saw in my earlier charts, is that this fund is going to deliver you that bond building block return, but with significantly less volatility, as you can clearly see. That's really what we're trying to do here. So if one looks at the returns over the 1 year period, for example, against the all bond index, even though the returns for the all bond index has been a lot lower than what it has been over the past, again, because of that rise in yields that we've seen, again, over 3 year periods, you can see, the fund versus the index. And again, 5 years, 7 years, and since inception, ultimately has been able to deliver on the objective. If one looks at it actually from a slightly different angle, so again, the top line being the actual return on the fund, the gray line being the all bond, the bond index, and then interestingly enough, over the life of this fund, you can see having even outperformed the domestic equities. So again, that just speaks to this issue around growth versus defensive and how you should be considering using the fixed income space as a significant building block within a client's funds because of that starting yield. And again, what we're trying to achieve here is to give you a return which is very similar to the all bond index. So this is the fund on the very left. You can see the return. It's a bit over the all bond index, and you can see the volatility on the horizontal axis is around half. So you're getting bond returns with half the volatility of the index. And then just by comparison, you can see where the all share index has been, again, against the bond index. And then, hiding away on the bottom right there is that listed property index. And that's really as a result of probably, most likely if you want to put one single factor down to COVID and the sort of hybrid working models that have come through. In terms of the high yield fund, you can see the volatility on this is very low. Again, the brighter blue line is the all bond index with its volatility, even though it's been going up. But you can see high yield ultimately, apart from the COVID shock, when credit spreads blew out, is that this fund's tracking the interest rate cycle, consistent income being paid monthly, with very low volatility. I think also maybe just to point out the high yield fund, in a global context, high yield generally means low credit quality. And I'd like to just, emphasize here that, the high yield fund is not a credit fund. We will use credit where appropriate, but it's not predominantly a credit driven fund. It's about being driven by the change in interest rates, ultimately coming out of the SARB. And again, if one looks at the returns over various periods, again, consistently against, essentially the STEFI composite, which is the money market type return, i.e. the low volatility, the very, very low volatility side of things. Consistently, this fund has delivered against the investment objective and without taking excessive risks. And again, this, just looking at this sort of line, you can see that this fund, relative to ultimately, suppose you could say the peers being the grey side, as well as the sort of that middle line, this fund, and you can see the reason why we sort of were able to deliver performance that could win a Raging Bull Award on this particular fund. So if I just think about the future in terms of expectations, and again, remember these are not guarantees, but again, it's just looking forward and saying, given the base case scenarios that we're looking at in the bond space, because remember, flexible income tracks bond yields, high yield tracks interest rates, right? So bond yields we expect to remain in a range, unless of course you had a negative shock to the system, and we there's any range of things that could shock negatively. So we're looking at returns on average of around about 12%. And it ties up at the moment with that starting yield that I spoke about earlier of 12% for a 10-year bond yield. So that really gives you that indication of the sort of returns that you're getting out of an income fund. And again, I'll highlight here is that I said, what would it take for you to lose, not to lose, but to get a zero return over the next 12 months? Well, bond yields would have to go up by 2%. Having said that, if we got a rally after the election, because it was a sort of a muddle through type scenario, and you had a bond rally of 2%, well, then you're going to get your income return of, let's call it 10.5%, and you're going to get an additional 11% return in terms of capital. So you're looking at a return of over 20%. Again, I'm just highlighting that as a scenario or possible scenario. So a 2% up in bond yields means you get zero. A 2% down means you get 20%. And I think that highlights just again, this is a through the cycle fund. So what we're looking at is saying, if you want a through the cycle income fund and you're prepared to withstand some of the volatility, and you saw that chart where I split it out, you know, this would fit into the right category for you. High yield fund, low vol, monthly income, floating rate, determined by whatever the SARB does. If inflation behaves itself and SARB cuts rates, well, then it'll be a lower return from where it is at the moment. But again, you know, our position is going to be that, you know, the SARB is going to wait first for the Fed to cut before they would do the same. So again, very nice returns out of this space. But going forward, ultimately, as the rates start normalizing again, you'll probably see those sorts of returns starting to decline. And that's where I'm going to end. Again, if there are any questions, you can post them in the chat box, and we'll deal with the questions right at the end. Thanks very much.
Brilliant. Thanks, Arno. Certainly a very compelling case for income investing. You know, obviously quite interesting there. I think you know, your starting point is around 10-11%. In those income funds, which means over the next 12 months, you know, clients will, you know, as a starting point, get 10 or 11%, and probably, you know, depending how the market goes, either a little bit above that or a little bit below that. But in the context of trying to achieve inflation plus returns for your clients, you know, historically that flexible income fund specifically has given clients, you know, inflation plus 5 or 6% with very low volatility. So definitely something to look at, worth considering. As Arno mentioned, guys, please just feel free to put any questions you may have in the chat box, and then we'll deal with those at the end of the presentations. Errol, thanks Arno for that. So I'd like to welcome Errol Shear, certainly another doyen of our industry. And probably you can't really argue the father of absolute return investing in South Africa. Errol spent many years at Stanlib, and then later went on to be the CIO of the Absa Asset Management business, and grew that very successfully. Errol has now been with Sasfin for, I think, close on 6 years now. And Errol will be talking around multi-asset class investment, and specifically with his low multi-asset, low equity mandate that he runs. So over to you, Errol.
Thank you, Martin. Is that slide coming through?
Not yet. We're just still seeing you. Let's give it a minute.
Sweet.
Okay, it looks like it's thinking. There we go. Just put it into presentation mode.
Sorry.
There we go. Perfect.
Okay. Good morning. No. I'm going to talk about the Sasfin BCI.
Sorry, Errol, it's just gone back into. You just need to go back into presentation mode. Perfect.
Okay, I'm going to talk about the Sasfin BCI stable fund. This is for the serious investor, the cautious investor, who wants the best of all worlds. And yes, in some respects, you can have your cake and eat it. we're about caution. We don't want to smash your savings to pieces. At the moment, there are many reasons to be concerned. We have election uncertainty in this country, and I suppose also in the USA later this year. High unemployment of the order of 42% on an effective basis, decaying infrastructure in the country. We have high interest rates, which are stifling economic growth. We have crime, we have corruption, we have geopolitics, Ukraine, Middle East, Northern Korea, global warming. There are many reasons to be concerned and to be cautious with your money. I'll come back to it later. Let's start with just one point. The SA elections coming up on the 29th of May. This is the recent Ipsos poll. It shows the ANC for the first time in the new South Africa support going below 50%. The Ipsos poll showed 40%, which, if this actually came through in 2 weeks' time, it would mean that the ANC would need, they still would be kingmakers, but they would need support of one of the other big parties, not just one of the smaller, one or two of the smaller parties. So either they go to the right, to the DA, or they have a coalition with the EFF on the left. I don't want to speak politics, but the DA are on the right, would probably be good for the economy. I'm a bit uncertain as to whether the ANC and the DA can work effectively in a coalition, however. So we're not quite sure how that would pan out. An ANC-EFF coalition, also, they're not natural partners, but it could happen. The EFF is unashamedly left-leaning. If you think leftist governments, think of Venezuela, Cuba, Zimbabwe, and so on. Not good for the economy. The official manifesto includes talk about nationalizing the Reserve Bank, which means we probably end up with hyperinflation, nationalizing the mines and other core assets, which is not good for the stock market. So there are two scenarios there. Neither perfect, I must say. The one to the left, worse for investments. But polls had me wrong in the past. It's possible the ANC ends up with close to 50%, either above 50 or a coalition with some of the smaller parties, and the status quo continues, but with the ANC more aware of the need to grow the economy. So I could see either negative or a positive outcome from the upcoming elections. We don't know. There's risk involved. Now, let me swing it around and say, why should we be cautiously positive? There are several reasons why I personally am feeling more positive at the moment. Load shedding has reduced. I cannot recall when I last checked my inverter to make sure the backup power is available. The Rand has recovered off a weak base. It was over 19 Rand to the US dollar less than a month ago. I see 18 Rand 23 this morning. Interest rates are high and should decline in South Africa and around the world. El Nino is weakening, which should be good for agriculture next year. South Africa is resilient. We've been through some terrible times, and yet we survive. And lastly, South African markets are cheap on a historical basis. JSE companies are being bought out. What are we missing? We all say our market's going nowhere, maybe, but it is cheap. Why is Billiton making a bid to buy out Anglo American? Because Anglo is cheap. Why is Canal Plus making an offer to buy out MultiChoice, DStv? Because it is cheap. Why did international investors buy the whole or buy out Mediclinic? Why did Heineken buy Distel? Why was Textainer bought out? We have many solid companies in South Africa which are cheap on a long-term basis. I don't care about flows of funds in and out and overseas sentiment. I look at fundamentals. On fundamentals, the SA market is good value on a long-term basis. Coming back to the reasons to be positive. On the load shedding, Eskom energy availability factor has soared in the last few months. I know we are all cynical, I myself included, say, well, what about the 29th of May? Will load shedding come back on the 30th of May? Maybe. but so far the data is fairly good. And one of the reasons we are having, one of the big reasons we're having less load shedding is not because government has fixed up the power stations. It's because when I go for a run in the morning, every second house has solar panels on the roof in our area. Every shopping centre, every mine, every factory either has or is talking about putting up solar panels to supplement Eskom supply. So load shedding, which has been a very big negative for our economy, is looking like it could be less bad going forward. I'm not saying going away completely. I'm just saying less of a negative, i.e. a positive. If I look at the currency, I've got a chart here from Standard Bank. They've looked at some major political events in the past, and they've gone 3 months before and 3 months after the event, which is the blue vertical line. The grey line was Nenegate 2015. My Minister of Finance was fired during the Zuma era. This is an index rand. Actually, it wasn't 19 rand. It was indexed back to equate to the equivalent in today's terms of 19, 3 months before the 29th of May. And you can see the grey line weakening from 19, the equivalent to today's money terms, or well, almost 24 rand to the dollar. And it weakened before the event and after the event. When Ramaphosa was elected as president, initially the rand 3 months before started weakening, and then a few weeks before Ramaphosa was appointed, wasn't election time, the rand started strengthening and actually continued to strengthen after Ramaphosa was appointed president. The blue line is starts at 3 months before the current election, and you can see the rand tracked sideways and is now starting to improve. 1823, as I said this morning. If it follows the Ramaphosa line, we could actually see a 17 rand per dollar after the election if the election does not go too badly. Now, I don't know how the elections will turn out. All I'm saying is don't be too negative. The rand is undervalued. My own view is there's a more than a 50% chance that the rand appreciates, then depreciates in the next few months. I'm not saying for the next 100 years. I'm just saying short term, the rand does look very cheap. The value does lie in the rand short term. If I look at investing in bonds, as Arno pointed out, this goes back 20 years. The 10-year bond rate is the best. I'm speaking as an investor now. Obviously, if you're a borrower, it's the worst. But if you're an investor, like most of the people on the call are, to earn 12% in your bonds, that's a great rate. I don't mind putting some of my personal money into bonds at a close to 12% yield. If I compare South African bonds to US bonds, we have a 7.5% greater yield on our bonds than the US bonds, which does compensate, certainly to some extent, for the risk of a weaker rand. And as I said earlier, I see slightly more chance of the rand strengthening and weakening over the next few weeks, but no guarantees on that. I could be completely wrong. Inflation linkage, one of my favorite assets, yielding over 5% real. This is a great asset for the long-term investor who wants to beat inflation. I'll come back to this later. If I look at our own stock market, the JSE, as I mentioned earlier, the foreigners are buying our companies out. Foreign trade investors see South African companies being underpriced on the JSE, irrespective of institutional flows. If I look at the price-earnings ratio on the banks in South Africa, it's pretty cheap, more than one standard deviation below the long-term average. The only times it's been cheaper was the great financial crisis, briefly, and briefly during COVID. Our banks are cheap, as are many other of our listed companies. If I look at inflation rates, what's happening in the States, the green line is US inflation. It came down fast in the last few months, has moved sideways. Yesterday there was more encouragement that US inflation is coming down, albeit slowly. I expect inflation in the USA to come down, but not immediately to 2%. The red line is the 3-month US TB rate. The American Fed control that effectively, and they will not allow that to drop until inflation looks like it's going back to below 2% and unemployment starts picking up. And on unemployment in the USA, it is picking up. It's following similar patterns to previous cycles in America on unemployment. It doesn't go from 3% to 5 or 10% in one day. It happens over a period, but for two reasons: falling inflation and rising unemployment in the USA. I expect the Americans to cut interest rates, not this month, maybe the third quarter, maybe in the fourth quarter of this year. But when interest rates fall, it should be a boost to markets around the world, including South African markets. Now let's look at my favorite fund, the Sasfin BCI Stable Fund. What are we trying to do? Our objective: inflation plus 4% per annum to protect our clients' real investments over time. We aim to do that over rolling 3 years, and we aim to do it with lower risk. I always say, when people talk about what return should they get, I say, as long as you're keeping up ahead of inflation, that the real buying power of your investments is helping you or allowing you to maintain your lifestyle, that's all you need. And we aim to do that by more than 4% a year. We have a core of quality fixed income assets with addition of equities, maximum 40% equities in terms of our trust deed, which means we cannot take too high a risk position in the asset allocation for the portfolio. We risk control both strategically through asset allocation to equities, property, and other classes, and also individual stock selection. What do I mean by that? Individually, we try and avoid the higher risk stocks. We let others play what I call the more dangerous stocks. We are investors, not speculators. So if you look at the stable fund, we had no Steinhoff in the portfolio. We had no Tongaat in the portfolio. Why no Tongaat? Some of my colleagues had Tongaat. You looked at the cash flow, you looked at the extended balance sheet, there was risk involved. We said these are not shares which are right for our clients who want stable returns. When we look at fixed interest assets, no B grade bonds. We do not lower our standards. We don't agree with the South African government Department of Education to allow people to pass matric with 2 subjects at 30%. We don't want 30% as our pass mark. We say our pass mark is we try and stay with A grade credits. Our emphasis on asset allocation and the portfolio is designed for the more cautious client who still wants his money to grow faster than inflation. On the right-hand side are the track record of my funds as a fund manager at Sasfin and before, indexed back to 100 many years ago. The grey line is our objective, not guaranteed, our objective of inflation plus 4% index. The dark line is the performance of our funds in the stable category, both indexed to 100 at the start. And you can see 2 things here. One is the blue line. Our index return tends to be, as the name says on the box, a stable return. The only exception briefly was at the start of COVID. And the other thing is that over time, we have kept up and exceeded our target of inflation plus 4% per annum. No guarantee for the future, but over many years, our strategy has worked. Where are we positioned? Our asset allocation, equity, South African equity, we're at 29%. We can go to 40% in total equity. We have 10% in foreign equity lower down. So we're at our max in equity. We see value, fundamental value, in South African equities. We think if you're a betting person, we're not betting people, but equities offer above average prospects in South Africa going forward. On property, we cut this back just about back to 0. We've increased that slightly in recent months. We think there is some value in property, yields of roughly 10%, plus we think we are close to the bottom. We are still cautious about office property, but our biggest position is in Vukile a well-managed property company with most of its exposure to retail, which benefits from inflation, and almost half of their portfolio is in Spain, which has seen somewhat of a boom in property values. Inflation link is one of my favorite assets, almost a fifth of the portfolio. And just to explain inflation linkers, we're buying them now at roughly 5% real. The way the mathematics of inflation linkers work, if inflation is 5% over the next year or till maturity, and we have a real return of 5% which we bought, we will earn 5 for inflation plus 5 real is 10%. If we have a government coalition in the future which is leftward focused, Julius comes in, and we have a leftist Minister of Finance, nationalised the Reserve Bank, inflation goes Zimbabwe style to 100%. If inflation is 100%, our inflation linkers give us a real 5 plus 100 or 105% to protect our clients against inflation. We love inflation linkers. We would have more, but there are some specific risks, particularly on liquidity on inflation linkers. Fixed rate bonds at 12% when inflation is 5, great return. So we have just below 80% domestic and 20% offshore, a diversified portfolio. We can't predict the future, and we think diversification is very important for all investors. If we look at our returns on a relative basis, taking 3-year returns in quartiles, we've been mainly in the top half, in fact, mainly in the top quartile compared to our peers, according to the Morningstar survey. If I look at returns, going back to yesterday, rolling 12-month returns, annualized returns, our SASFin stable fund over the last 12 months ending yesterday, 9.6%. Our average peer in the category, 8.8. Over 3 years, 9.2. Over 5 years, and it's been a difficult 5 years with COVID, load shedding, weak economy. We still managed an average of 8.9% yesterday per year, compared to the average of our peers of 7.5%. Over time, we aim to be 2% ahead of our peers. And really, at this point in time, we think it's a great time to invest in something like the SASFin stable fund. Now we should invest. Pessimism is high, and the markets are valued for pessimism. Interest rates are high, bond yields 12%, the equity market looks cheap. We think it really is a great opportunity to invest in a fund where if things go wrong, you have great protection. If things go right, this fund could easily earn 20% or more in a good year. Thank you very much.
Brilliant. Thank you, Errol. And thank you for those insights. Certainly a compelling argument for your strategy. Again, just a couple of takeouts there. You know, it's not all doom and gloom for South Africa. I think there's a number of scenarios, you know, that are positive, and certainly from a local equities perspective, you know, definitely something to start looking at. And again, you know, Errol's been around, you know, in the industry for over 30 years, probably close to over 40 years. And as you saw on his slide there, if you're looking for CPI plus 4%, Errol has been able to achieve that for nearly over 20 years now. So if you and your clients are looking for CPI plus 4 in a diversified portfolio, the SASFin stable fund is certainly something to look at. Brilliant. Thank you, Errol. Appreciate that. I'd like to just introduce our next presenter, Andrew Padoa. Andrew doesn't have necessarily the grey hairs that the previous two panelists have, but he's certainly been in the industry for a number of years, and is definitely a rising star within the SASFin wealth business. Andrew is a senior portfolio manager. He's based in Durban and looks after the Durban branch. A lot of you may know Andrew through some of the press engagements that he does, you know, on an ongoing basis. And as I mentioned, you know, he has a number of years, and Andrew's going to be taking us through the case for global equities. which is definitely something that all investors should be looking at. Whether you're positive on South Africa or negative on South Africa, it's definitely something that you should be looking at. Over to you, Andrew. And just a quick reminder, guys, if there's any questions, please just post them in the chat boxes below. Over to you, Andrew. Thank you.
Great. Thanks very much, Martin. Can you see my screen?
Yes, I can.
Okay, great. All right. Thanks, Martin. My presentation is less than 10 minutes. I have 6 slides and 1 question for you. So let me start with the question. If I had to give you $1 trillion, but the deal was you had to use these funds to start a business and compete against a publicly listed company, which companies in the world would you absolutely not want to compete against? Who is just so powerful you wouldn't even try? Or maybe you would try, but it's going to take you decades to make any meaningful dent in their market share. So these types of companies all have massive competitive advantages. Warren Buffett has a great analogy here. He talks about these companies being like a big castle with wide moats and monster crocodiles in them, making it very hard for anyone to come and attack them. These are the types of businesses that we want to invest in. We are making decisions here, not for the next 6 to 12 months, but for the next 5 to 10 years. And what really works in investing over the long run is investing in companies with strong competitive advantages that can reinvest into the business, back into the business at high rates of return and compound their earnings. Capitalism is brutal. If you have a business or if you start a new business model like Netflix did, like Tesla did, and you are successful, you will attract competition. So the question is, how are you able to keep the competition away? That's what a competitive advantage is. It's these companies do something special to keep the competition at bay. So I wanted to run through a handful of competitive advantages that exist and highlight some of the companies that we hold that fit into these various competitive advantages. So the first one is monopolies, duopolies, oligopolies. So you've got a quote there from Peter Thiel. If you want to create and capture lasting value, look to build a monopoly. Competition is for losers. ASML is the company that sits on the top of the supply chain for semiconductors. Nobody in the world can do what these guys can do. They sell the massive machines. They are the size of double-decker buses, cost 350 million euros a machine. And they sell these machines to Samsung and to TSMC, which is Taiwan Semiconductor Manufacturing Company. What ASML do is so difficult. It's like driving from Durban to Pretoria and being half a meter off target. It won't work. It's taken them 30 years to build the technology that they've developed today. The Japanese tried in the 1990s and gave up. They didn't think it could be done. So ASML's competitors don't have the time, they don't have the resources, they don't have the knowledge to catch them. So ASML is effectively a monopoly. You've then got Visa. You could call Visa the toll booth between the shopper and the merchant. So instead of going to the shops and buying something with cash, if you pay with your bank card or if you even buy something online, it's either Visa or MasterCard that are enabling you to purchase your goods. So Visa and MasterCard operates in a duopoly. And then we've got on the right-hand side, the S&P Global. S&P Global is one of the major rating agencies in the world. So you've got S&P Global, you've got Fitch, and you've got Moody's. So these 3 rating agencies have a long history and established reputations, making it difficult for new entrants to come in and take market share. So just speaking on long history, S&P Global was founded in 1860. So they've been doing this for more than 150 years. Reid Hoffman has a great quote here on network effects, and Reid Hoffman is the founder of LinkedIn. So the magic of network effects is that they generate a positive feedback loop that results in super linear growth and value creation. So the idea behind network effects is that the more people use a product or a platform or a service, the more valuable that product, platform, or service becomes. So the more people using Facebook, Alphabet, or Amazon, the more advertisers would want to advertise on these platforms. Uber is not a company we're invested in, but it's a great example of a network effect. The more people use Uber, the more Uber drivers there will be. And the more Uber drivers there are, the more people would want to catch an Uber. With regards to high switching costs, so this is where you become so entrenched in a company's ecosystem, it's really difficult to get out. So Apple's a good example. I have an Apple phone, an iPhone, and I've had one for a couple of years now. I'm really entrenched in the Apple ecosystem. It would be tricky for me to move to another provider for my phone. Microsoft, another great example, and I speak for all my Sasfin colleagues here on the call. If the CEO of Sasfin had to email us all today and say, look, guys, Microsoft raised prices by 10% overnight. It's starting to cost too much. We have made the decision. We are moving to Linux. There would be absolute chaos in Sasfin. I can tell you that for free. We are so entrenched in the Microsoft ecosystem. It's really, really difficult to move anywhere else. And then my final high switching cost example is Stryker. Stryker is probably not as well known to most of us on the call. They're a medical technology company, but one of the best medical technology companies in the world. In the 2023 Stryker annual report, they give a story which kind of explains the high switching costs. It's worth reading if you're interested. A young lady was in a really, really bad car accident in Texas, very, very badly injured. Her left leg was, shattered in multiple places. Her right leg was amputated at the scene of the accident. She was airlifted to hospital where the trauma surgeon was waiting for her. Now, the trauma surgeon, he can't really plan ahead. As patients come in and surgeons need to figure out very, very quickly what to do because every second counts in a trauma theater. One of the first calls he made was to the Stryker consultant to figure out to give guidance on the product options, so including the screws, the length of the implant, as well as the plate selection. Importantly, this information was given very quickly to the surgeon so he could start the operation as soon as possible. So surgeons rely heavily on Stryker's consultants. The cost to switch to new product providers would be tricky as the new company's products, maybe in different shapes and sizes. So surgeons would need to free up their diaries, not have any operations, and start training on these new products, build new relationships with other consultants. So there's a long learning curve to becoming proficient in using companies' instruments. So if you're a surgeon in the Stryker ecosystem, it's difficult for you to move. So great example of a high switching cost. And then the final one comes down to luxury goods and its strong, prestigious brands. I've got a quote there from Bernard Arno. He's the CEO of Louis Vuitton. So luxury goods are the only area in which it's possible to make luxury margins. Luxury goods companies all have something in common, and that is a rich heritage. It takes decades to build strong brand identity and the element of scarcity. You can't just flood the market with thousands of products to make sales, as you won't be a luxury player anymore. You have to ensure that there's this exclusivity. You can only sell a certain amount of Ferraris or a certain amount of Louis Vuitton handbags to ensure that exclusivity of the brand remains. So Ferrari was formed in 1929, so they're almost 100 years old. In their history, they have only sold 250,000 Ferraris. That is it. Porsche, or Porsche, however you say it, they sold more cars last year than Ferrari has done in their entire history. Louis Vuitton was founded in 1854. It's taken them more than 150 years to get to where they are today. So if you want to take these guys on, be prepared to fight for 150 years. So I hope this gives you an idea of how we are thinking on the global equity side. Maybe you can tell I'm rather passionate about these types of passionate about investing in these types of exceptional businesses. If this type of thinking resonates with you and you want more information, please feel free to reach out and we'll gladly assist. Thanks very much. That's me, Martin. Thank you.
Brilliant. Thanks, Andrew. I think, a lovely insight. Maybe just, you spoke about legacy, etc. Just to maybe worth mentioning that Sasfin is an over 100-year-old business. We were founded in the 1890s when the guys first found gold in Johannesburg, and you had the stockbrokers kind of trying to get some of that money then. And interesting just to note, we're an over 100-year-old business, And today we manage more money offshore. That's money that sits overseas than we manage locally, which I think just gives you a sense in terms of where the growth and the opportunities sit. And I mean, I think to Andrew's point there, if you've got 100 Rand today, you want to be able to look and invest that 100 Rand in the best companies around the world. It's really easy to invest around the world. It's something we've been doing for a long time now. And you don't have to just invest it locally in South Africa any longer. So yeah, we have that ability to take that 100 Rand and really find the best companies around the world that are going to get you those returns that you would like. Yeah, thank you for that, Andrew. Maybe just to kind of answer a couple of questions here in terms of how do we access all of these different portfolios and strategies that we offer. So I think maybe firstly, if I can start with Andrew, he's on the screen now. As I mentioned, Andrew is a portfolio manager. We run share portfolios. I think share portfolios is something that certainly for high net worth investors is a great opportunity. It's quite different to CISs and the way CISs are managed, and it certainly gives you a different value proposition for your high net worth investors. Share portfolios today, they're available either directly through with SASFIN for discretionary monies, but for your retirement monies, the share portfolios are available on a number of platforms. And it's really an area that we're looking at now. Well, not looking at now, we've been doing for a number of years, where a client can invest, let's say, for example, pension fund money in an RA that sits within a share portfolio alongside unit trusts, or simply just directly in a share portfolio. So it's certainly something different. It's something unique. I think we're always looking, to try and add value to our clients' portfolios. And share portfolio investing is not as scary as maybe it once was. As I said, it's something that we've been doing for over 100 years. And if you would like more information on that, please just chat to your BDMs or get in touch with us with us directly. Just in terms of the other two strategies, from a multi-asset class perspective, the mandate that Errol Shear runs is the SASFIN BCR stable portfolio. That portfolio is available pretty much on all the platforms, and is definitely something in this current environment to look at. I think Errol made a really good case for investment there, and the opportunities that lie ahead for a portfolio like this. And then Arno started with on the income side, our two core income strategies, which is the SASFIN BCR Flexible Income Fund and the SASFIN BCR High Yield Portfolio. Two portfolios that certainly for clients that are looking for income is something to look for. And again, both of those portfolios are available on most of the platforms that you would utilize for your clients. So I don't see any further questions or anything further that anybody else is looking for. As I mentioned, please get in touch with your BDM in your region. If you don't have a BDM currently, please feel free to reach out to myself or anyone else at SASFIN that can put you that can take you in the right direction in terms of who to chat to. We're obviously looking at hopefully holding more webinars going forward. Thank you very much, everybody, for your time. It is valuable. So thank you very much for that. And if there's no further questions, we'll say goodbye and enjoy the rest of the week. Thank you.